of clients, of course, or people are thinking, okay, how much am I going to pay for this? So address how advisors are paid.
Oh, great question. So advisors are usually paid one of two ways, fees or commissions. Okay? And it's not that commissions are bad. But as you could argue sometimes that if an advisor is paid commissions on every time they buy or sell something, then you can see where a little bit of a conflict of interest could arise, that the more buying and selling, the more fees and commissions. So you hear a lot of times, to create more of an advisory type relationship, or some people call it fee-based, but it's where you have a relationship to where the advisor just gets paid a fee. I see that fee being anywhere from 0.75, maybe 1.25%. You hear this average of 1%. And in a lot of ways, that creates a kind of a better environment of a win-win, lose-lose. But it creates a situation to where if I'm getting paid as an advisor a certain percentage, then if the account goes up, I get a pay raise. If the account drops in half, I got to go home and tell Marcy and the kids our income just dropped in half. It's one of the only structures that puts the advisor and the client on the same side of the table. We both want money to grow. We both want to manage risk on the downside because neither one of us want to lose 50% of what we've got. That structure also keeps things a lot more flexible. So if they, if it's the same, whether we make 2 or 3 changes or we make 10, it's all the same. If we're 100% stocks, 100% bonds, we decide to sell everything and just sit on the sideline, it's all the same. So it creates that conflict of interest, kind of pushes it to the side because you and the advisor, your all's interests are aligned, and you're just trying to do the right thing at the right time, whether it's more stocks or more bonds or more cash or whatever you decide, because that doesn't change how you get paid. Whereas if I get paid every time you buy or sell something, you can see how that works. And as a fiduciary, it kind of holds you on the same line in that regard. So that's kind of the trend. That's where you're seeing. And it also keeps things flexible. If I decide, I want to take my money out and do something different, you can. I'm not locked into anything. I think the only exceptions to that is there's times where maybe it makes more sense to just pay a commission or a transaction fee. Maybe I'm keeping everything in a money market or a CD. And they say, hey, 1 year CD is paying 4%. Well, it's not that there's no fees. That 4% just has whatever fee or transaction cost built into the rate. But when you're just doing that for a time frame, it makes more sense to just, not have a fee or an advisory. That's more of a transactional type investment. You see that a lot with fixed annuities. Fixed annuities, 3-year annuities, 5-year annuities, they may be paying 5%. So again, it's not that there's no fee. They just have whatever commission or compensation built into that rate. But if I'm going to buy a 3-year, CD or a 3-year fixed annuity that's paying 4 or 5%, then you just know that the bank's holding on to that money, or the insurance company's going to hold on to that money for 3 years, and they just build it into the rate. So those things are appropriate at times. And then really anything related to insurance. I mean, life insurance, health insurance, long-term care insurance, usually those type of things, your premium is premium. They pay a commission. So those things, depending on what you're trying to accomplish, all of those things kind of make sense depending on the situation.
What's the difference between tax planning and tax preparation?
Night and day. I think most people have relationships where it's tax preparation. You wait till the end of the year or beginning of the year, January, February, you get all your 1099s, you get your W-2s, you get your K-1s, you go to your CPA, and the CPA takes everything, they plug it in, and they say, okay, you made X amount of dollars, do you want to contribute to an IRA or not to try to get it down, and here's what you owe. The tax planning is probably more important, but it's hardly done. But the tax planning is thinking through, not after the year's done, But in our world, or in a perfect world, you kind of get together a couple of times a year. So you get together January, February, and you're thinking through, not last year, you're thinking through what's the plan for the year. What big expenses, what major purchases, what life events do I have? All right, where's the income going to come from? What do I need? Where should I pull it from? Because you're trying to take care of all these things with the least amount of taxes possible. So that takes getting into life and goals and budget and expenses and income that you're not doing with the CPA. And then I think the other best practices is you get together in November, December, before the end of the year, but you walk through the same review, the same exercise. What big expenses, major purchases do I have? What does that look like? What income for the year? What do I need to do before the end of the year in order to save money on taxes? What purchases, what big expenses, what can I run through the business, what can I not? Usually around that time is good too, because any elections that you have at work, usually that open enrollment or things that you can do is in September, October, so you have enough time by the end of the year to put more money into the 401k or take advantage of a stock purchase plan or HSA or whatever those things are. But that's a big difference between just prepping taxes and getting more proactive with the resources that you have to either get you in a lower tax bracket, keep you in a lower tax bracket, or just spend money differently because everything is taxed so much different.
Sometimes people expect when they come to visit with you that you're just going to give recommendations of what they do with you. Explain a couple of examples of how you make recommendations to them as a whole, even at work, and how that is so important.
The reality is that happens a lot. I mean, when you dig into somebody's life, you're uncovering checking savings, emergency money, debt, credit card debt, certain debt, parent situations, wills, trusts. So, I mean, there's a million examples. I mean, half the things may be what we can do, but the other half is, all right, what order do we go in? I need you to do A, B, and C first. I'll give you a bunch of examples. We had a client, had a couple $100,000 that we're just kind of earmarking for emergencies. The target makes him feel comfortable was about $100, and then keeping another $100 for a future purchase. So we looked at the big board on CD rates, but we found a CD at the credit union in that I knew about. So I sent him over there to get his CD renewed because it was paying at the time like 5.5% when everything else was paying 5%. So that's one example. We got a lot of examples to where you may have a business owner that's running their business as a sole proprietor that makes good money. But man, if we can create an S Corp or an LLC, reconstruct how they're taking income, get money down, take part of it as a W-2, take the rest as a flow-through, in order to avoid FICA, Social Security, self-employment tax. I see that a lot. That's something I can't do. We've got to go and get the attorney or the CPA to create the S Corp. We got to get the CPA to create the payroll. So those are things that we see all the time that I don't do, but is a recommendation to be made. I see a lot of times that people will create a will or a trust. We have to get that done. But they create this beautiful trust, but they don't have the assets titled correctly in order to avoid probate, make sure everything follows the language of the trust. So sometimes we got to get involved and get deeds transferred, or get them to go to the bank to get a transfer on death agreement to reflect the language. I see that a lot. See a lot of debt. Let's pay this off. Let's pay that off. I mean, if we're paying things, boat, RVs, we're paying 6, 7, 8% interest rates. There's not a mutual fund in the country that guarantees 7, 8, 9, 10%. So you do that a lot. There's all kinds of examples. I mean, part of planning is just understanding all these things, how they tie together, and then what's the smartest order to put things in.
accumulation phase versus the distribution phase. How is it different, and why is it a different plan?
You know, when people are saving for retirement, it's you know, you're more concerned with growth and appreciation of assets. So your investment strategy, usually you're saving money on some kind of frequency. Maybe it's monthly, maybe it's quarterly, maybe it's once a year. But your investment strategy is really built more for growth. You got kind of some time. You want money to grow. So the vehicles that you may be using is different. The objectives of the funds are different. But you know, you naturally, you're more concerned with growing money and money appreciating. During the distribution phase, you're more concerned with, all right, how do I take all these assets, and I'm trying to figure out a way to provide the income that I need in order to have a comfortable retirement, you know, not be in a position to run out of money. So the mindset shifts a little bit, or the set of investments shifts a little bit, to be a little bit more income producing first, maybe growth second, because you still need money to grow to keep up with inflation and, you know, to keep up with the purchasing power 5, 10, 15 years from now. But that strategy shifts a little bit to more income producing assets. And if I'm not going to work anymore, maybe it makes sense too to build in a little more protective measures, you know, whether it's some principal guarantees or buffers or some kind of protective measures from market risk into the portfolios, because I can't afford for it to drop 50% because I don't have the time and I'm not making money anymore and I need these to last. So those strategies are very uniquely different in some aspects, but they're different. And that distribution phase, you know, it's not all money is created equal. So depending on how much I need to pay bills and be comfortable, I got to think through what comes from Social Security, what comes from dividends and interest, what else do I need, and where do I pull it from? Do I pull it from investments outside of retirement plans? Do I pull it from my retirement plans? Do I pull it from my Roth IRAs? But there's a balance in that you have to think through, because it could be the difference of paying 22, 24, 33% taxes or 12% taxes. So, you know, taxes, you play a big part of how that money comes out, which is very, very important. And I guess you would have to think through, there's some assets that are better to leave the kids. So maybe I need to spend this kind of money first. So that way at some point, if something happens to me and I want the money to go to the kids, I don't want to create a tax bomb for them. So there's the balance in that as well that you have to give some consideration to.
There's an old saying that you don't realize who's swimming naked until the high tide rolls out. What does that mean?
First, it's a little scary to think about. No, I mean, I just think that some people, it's pretty common that most people's investment decisions, right, or their process of how they select mutual funds and certain investments is all performance driven. I mean, they look at their 401k and they go, man, this one made 12%, this one made 4%, this one lost money. Let me sell the one that lost money in the 4%, let me buy more of the 12%. And they wind up chasing performance. I see it all the time. Big mistake. So the philosophy of buying low, selling high is the opposite. That's why the holding period for most mutual funds is less than a year, because people get impatient. They're always chasing performance. I think they get so hung up on performance that, you know, a lot of times they'll just look and they decide how to pull funds. They just click, they look at the 5 and 10 year return, and that's how they pick and choose, whichever one has the best returns. So then you don't realize how much risk you're taking until things hit the fan or the high tide comes back. Because then you're like, oh my gosh, how did I just lose 15, 20, 25, 30% in these funds or in this portfolio? It's because they're underestimating how much risk and volatility is involved with certain type of investments. So returns are important, but you also have to balance that out with how much risk was taking in order to get the returns that were there. And am I too concentrated in technology or certain areas of the market? And that balance really comes to fruition when things get real rocky. And people, I think they just underestimate the risk and volatility as part of that because they're just solely focused on returns.
When people turn 59 and a half and they're still at their employer's place, what's the advantage of doing non-hardship withdrawals versus what a lot of consumers are doing today?
Depending on the company, but there's different companies that allow for those in-service non-hardship withdrawals. And all that is a provision that at a certain age, if I wanted to, I could roll out a portion of my 401k to my own individual retirement plan, but still participate, still get the match, business as usual. Most companies are 59 and a half, some are 55, some are 40, some are anytime. And it just depends. Some companies, 401ks, they have unlimited investment options, so from an investment standpoint, great. Some companies only have a handful. They got 10, 12, 15 investment options. So, in a scenario to where, I just want more investment flexibility, then you see sometimes people roll portions of it out to their own individual retirement accounts because then they can invest in anything that they want to, whether it's mutual funds, index funds, stocks, bonds, gold, silver, Bitcoin, real estate, annuities, whatever. So there's an investment flexibility that sometimes people just want more choices. Sometimes people want just a little bit more, in type of investments that have a little bit more protective measures or principal guarantees. So where they can't buy a CD or a buffered annuity or a buffered ETF or a, gold or silver or, certain things inside of their 401k, they can do that in the IRAs. So sometimes you see it for a reason of some stability, some safety measures maybe, where sometimes most of the time in the 401k there may just be a short-term government bond fund or a stable value fund and that's it because you don't have the CDs and other things. Those are probably the big ones outside of the ability to get money out into an IRA, and maybe it makes sense for the next 3 or 4 or 5 years to convert part of that IRA over to a Roth IRA to avoid taxes down the road. I see that. And then I think the fourth one I see quite a bit, which is rare, but I see, is sometimes inside my 401k I've got a real highly concentrated stock position. I see it with some oil and gas companies, certain companies that, maybe my $1 million 401k or my $2 million 401k, I've got $800,000 in company stock, one stock, right? So, if I at some point diversify that or roll it over, then all of that gets to an IRA at some point, but then you're paying ordinary income taxes on all of it. So sometimes these plans will allow you to buy out that stock for whatever the basis is. So let's just assume that basis is $100,000, but now the current value is $800,000. So there's a strategy called net unrealized appreciation, or NUA, that I could buy that stock out of the plan, pay the $100,000. Now it's outside of the retirement plan, still worth $800,000. And if I hold that thing for a year, then when I sell it, it's not ordinary income anymore. It's long-term capital gains, which could be at 10, 15, or 20%. Or if I passed away, none of it's taxable because the full $800,000 gets us stepped up in basis because I bought it out for the cost basis of $100,000. So there's some scenarios where it makes sense. I see a lot with Exxon, Chevron, Train Technologies, where these people just have these, they're able to buy into the stock and the stock just took off, but their basis is so low that if you're not careful, when you do roll it out, you're just paying taxes on all of it, ordinary income, when maybe you don't have to.